Hi, everyone. As a university professor who teaches tax, I can tell you that one of the questions I get more than any other is, how do corporate taxes actually work in Canada? It can feel like this confusing world of percentages and acronyms, and it can be pretty intimidating. But in this explainer, we're going to break it all down and make sense of it together.
So what we're going to do is break down the core pieces of the Canadian corporate tax system step by step. My goal here is simple, to give you a really clear, straightforward understanding of a system that, let's be honest, affects every single business in the country. Let's dive in. So, let's start with the million-dollar question, right? How much tax do Canadian corporations really pay? If you've ever tried to look this up, you've probably seen a bunch of different numbers thrown around. 38%, 15%, 9%. What's the real answer? Well, the truth is, there isn't one single number. The tax rate a corporation pays really depends on its size, the kind of income it's earning, and what it ends up doing with its profits.
To get our heads around this, let's think of it like a funnel, a tax calculation funnel. We're going to start at the very top, with the highest possible rate, and then see how different rules and deductions narrow that rate down. We'll look at the starting point, the big deductions for businesses, how those deductions can be limited, the special rules for investment income, and finally, how some of that tax can actually be refunded right back to the company.
All right, first things first, let's start at the very top of that funnel, the absolute starting point for every corporate tax calculation in the country. This is the biggest number you're going to see, but as we're about to find out, it's a rate that very few companies actually pay.
And here it is. The basic federal corporate income tax rate in Canada is 38%. Now, when people see that, they often think, wow, that's incredibly high. But you have to think of this as just the theoretical starting point. It's like the manufacturer's suggested retail price on a car. It's the sticker price, but almost nobody actually pays that. In reality, this rate gets reduced almost immediately.
So how do we get from that scary 38% down to a more realistic number? Well, it happens in two main steps. First, the government applies something called a 10% federal abatement. This is basically the federal government stepping back to make room for the provinces to charge their own corporate taxes. And boom, right away that takes us down to 28%. Then, for most regular business income, there's another cut called the general rate reduction, which is 13%. So after those two automatic reductions, we land at the much more familiar 15% general business rate. This is the rate that most larger Canadian corporations are looking at for their active business profits.
Okay, now we're moving deeper into the funnel. And honestly, this next part is a huge deal for pretty much every entrepreneur and small business owner in Canada. We're talking about the Small Business Deduction, or the SBD. This is where things get really interesting and where we see a massive drop from that 15% rate.
And wow, look at the difference here. For a qualifying company, what the government calls a Canadian-controlled private corporation, which is basically a private Canadian company, the federal tax rate on its first $500,000 of business income is not 15%, it's only 9%. The whole point of this is pretty simple, to leave more cash in the hands of small businesses so they can reinvest, hire people, and grow.
Okay, so a 9% rate sounds amazing, right? But the big question is, who actually gets it and how is it calculated? Because it's not like every single dollar of profit qualifies. There are some very specific rules that decide how much of a company's income gets this special treatment.
The way they figure this out is a little weird. It's called a least of test. The small business deduction is 19% of the lowest of three different numbers. First, your actual active business income in Canada. Second, your total taxable income, with a few small tweaks. And third, the annual business limit, which is currently set at $500,000. For the vast majority of small businesses, it's that third one, the $500,000 limit, that really matters. That's the maximum income that can get that super low 9% rate.
But, it's not a free-for-all. The government wants to make sure this amazing tax break only goes to genuinely small businesses. So they created rules that can actually reduce, or as tax folks say, grind down that $500,000 limit. This means if a company gets too big, or if it starts earning too much from passive investments, its access to that low 9% rate starts to shrink.
So the first thing they look at is just how big your company is. They use this measure called, and get ready for the acronym, TCEC, or Taxable Capital Employed in Canada. It's basically a wide-angle look at a company's financial size, including its capital, its earnings, and some of its debts. Once a company's taxable capital gets over the $10 million mark, that grind down begins. Now, don't let the formula on the screen scare you. We're not going to do the math here. The main takeaway is this. The reduction is tied directly to how much a company's capital is over that $10 million threshold. The bigger the company gets, the smaller its access to that low tax rate becomes, and for really large corporations, it disappears completely. All right, the second way you can lose this deduction is all about passive income. The government's thinking here is, hey, we want to reward you for running an active business, not for just sitting on a pile of investments. So if a company and its associated group earn more than $50,000 in a year from passive stuff like interest, rent, or capital gains, their business limit for the next year also starts to shrink.
Okay, so that whole discussion brings us to a totally different part of the tax world. Everything we've talked about so far, that was for active business income, selling widgets or providing services. But what happens when a corporation makes money from its investments? Well, here the tax system has a completely different goal and the rules are totally different.
When a corporation earns investment income, it gets hit with a much higher tax bill right off the bat. This comes from some special, extra taxes that get tacked on. But the key word here, and you have to remember this, is refundable. So you got to ask, why would the government charge all this extra tax only to plan on giving it back later? What's the point?
Well, the answer is a really fundamental concept in Canadian tax called integration. And the goal is pretty simple, at least in theory. The idea is that you shouldn't pay a ton more or a ton less tax just because you earn that investment income inside your corporation instead of earning it personally. The high tax up front in the corporation is meant to be roughly equal to the highest personal tax rate. But that money eventually has to come out to a shareholder, so the system needs a way to refund that extra tax.
And that, my friends, brings us to the final and, probably the most complicated piece of this whole puzzle. It's the refund system. This is how the system makes integration work by giving back that high upfront tax, and it's all handled by something called RDTOH. RDTOH stands for Refundable Dividend Tax on Hand, and the best way to think about it is like a virtual piggy bank that your company has with the CRA. Every time your company pays that extra refundable tax on its investment income, that amount gets dropped into this RDTOH piggy bank. It's not actual cash sitting in an account, but it's a running total of all the tax that the company is eligible to get back. And just when you thought it was making sense, they actually split that piggy bank into two separate piggy banks. You've got an eligible RDTOH account and a non-eligible RDTOH account. Now, it sounds crazy, I know, but there's a good reason for it. It's because there are different kinds of dividends a company can pay out, and they get taxed differently in the hands of the shareholder, so the refund system has to match that. So, what fills up these piggy banks? Let's just focus on the more common one, the non-eligible account. Remember those high refundable taxes we just talked about? Well, every time the company pays them on its investment income, that money gets tracked and added to this refund pool.
Okay, so this is the real payoff. This is the whole point. How does the company actually get that money out of the piggy bank and back into its hands? The one and only way to get a refund from these RDTO accounts is by paying taxable dividends to its shareholders. When a dividend gets paid out, a portion of that RDTO balance gets refunded to the company, which brings its total tax bill way down. It's the key that connects the corporate tax system with the personal tax system. So, let's just quickly bring it all back together with our funnel. You can see it clearly here. We start way up at the top with that theoretical 38% rate. For most bigger businesses, that quickly funnels down to 15%. And for our qualifying small businesses, it narrows even further to that incredible 9% rate on their first $500,000. Each rate is there for a very specific reason. So, when you step back and look at all of this, all these different rates, these grinds, these refundable accounts, you realize none of this is by accident. Every single rule is there for a reason. And it leaves you with a really big question. If the tax system is built with this much detail, what is it trying to get businesses to do? It sure looks like it's designed to encourage active, growing, Canadian-owned small businesses, while trying to stay neutral on passive investing. It's a complex system that's trying to answer a lot of complex questions. Thanks for joining me for this explainer.